Most people step into the world of investing with dreams of freedom, fortune, and control, yet 90% of them lose, not because they lack opportunity, but because they lack discipline. They chase noise, not knowledge. They follow excitement, not evidence. And in the end, the market, that unforgiving teacher, humbles them all. The first rule to outsmart the crowd is to think rationally when others are emotional. When the masses panic, prices drop below reason. When greed takes over, prices soar above logic. The investor who can keep his head while others lose theirs doesn't just survive, he profits. Emotion is the enemy of good judgment. Second, remember this: ignorance with competence is fatal. Nothing destroys capital faster than a person who thinks they know more than they do. Markets have no mercy for arrogance. The best investors aren't those who know everything, they're the ones who know the limits of what they know. The moment you accept your ignorance, you start learning. And the moment you stop learning, you start losing. Third, beware of trends. Every generation believes it has found the new secret to easywealth.coms, NFTs, AI stocks, whatever is fashionable that year. The truth hasn't changed. Speculation is entertainment, not investing. The real winners buy value, not hype. They study companies, not headlines. They're content being boring while the rest chase fireworks. Fourth, patience is your greatest weapon. Compounding works only for those who respect time. The market rewards those who wait, not those who rush. Every successful investor has endured boredom, fear, and doubt, yet they stayed the course because they understood that wealth is a process, not a lottery. Fifth, understand that your mind determines your outcome. You can't control markets, but you can control your reactions. You can train your mind to stay calm in chaos, rational in noise, and humble in success. The investor who conquers himself doesn't need to conquer the market. The market eventually bows to him. Finally, follow the rules that never change. Stay within your circle of competence. Avoid what you don't understand. Seek value over popularity. Think decades, not days. And most importantly, avoid stupidity before chasing brilliance. The world rewards the few who do less dumb things than everyone else. So when the next crowd rushes to the next shiny idea, stand still. When the herd screams buy, start asking why. Because in a world where everyone wants to get rich fast, the smartest move is still to stay rational, stay patient, and stay disciplined. That's how you outsmart the 90%. Not with luck, not with shortcuts, but with the timeless power of rational thinking. The majority of investors are guided by emotion, not reason. They buy when the market feels exciting and sell when it feels painful. Their decisions rise and fall with the crowd's mood, not with logic or analysis. Fear, greed, envy, these three emotions rule the financial world more than intelligence ever will. When prices rise, greed whispers that this time is different. People convince themselves that they are smarter, luckier, or faster than the rest. They stop questioning, stop thinking, and start following. When the market crashes, fear takes the throne. The same people who were shouting buy now panic to sell. Their mindset flips from confidence to despair in a heartbeat because their foundation was never reason, it was emotion all along. The rational investor stands apart. While the crowd feels excitement, he feels caution. When the crowd panics, he feels calm. He knows that emotions are designed for survival, not for success in markets. The brain evolved to escape danger, not to calculate intrinsic value. So he builds systems, rules, and habits to protect himself from his own impulses. He studies history and sees the same pattern, repeating every bubble born from greed, every crash born from fear. Most investors don't lose money because of bad luck. They lose it because of bad behavior. They trade too often, listen too much, and think too little. They measure their success by others' opinions instead of their own reasoning. The truth is simple. Emotion is the great destroyer of wealth. Those who can control it win. Those who can't become part of the 90% who fail, not because they didn't know what to do, but because they couldn't stay rational when it mattered most. Ignorance disguised as confidence is one of the most dangerous forces in investing. Many people enter the market armed with enthusiasm but no real understanding of what they're doing. A few early wins make them believe they have mastered the game. They mistake luck for skill, and in that illusion of control, they become reckless. They start taking bigger risks, convinced that their instincts are superior to everyone else's analysis. But the market has a brutal way of exposing arrogance. It rewards the humble and punishes the overconfident. Those who think they know everything stop learning, and that is where their downfall begins. True wisdom begins with admitting how little you know. The intelligent investor questions his own assumptions, seeks contrary opinions, and studies the limits of his understanding. He doesn't fear uncertainty, he respects it. The problem with most investors is not that they lack knowledge, but that they never question the knowledge they have. They build castles of confidence on foundations of sand, and when the tide turns, those castles collapse. Every financial disaster, every bubble, every collapse has roots in collective overconfidence. People convince themselves that this time it's different, that old rules no longer apply. They believe the trend will last forever, that they can exit before the crash, that they are the exception to history. But history humbles everyone who believes that. In investing, humility is not weakness, it is survival. The market doesn't care how confident you feel, it only cares about truth and numbers. Confidence built on ignorance blinds you to risk, deafens you to warning signs, and leads you straight into ruin. The wisest investors remain cautious even when they are right, because they understand that arrogance is the prelude to disaster. Chasing trends is the fastest way to fail in investing because it replaces thought with imitation. Most investors don't want to think deeply about value, fundamentals, or long-term potential. They just want to follow whatever seems to be working right now. They see prices rising and believe they've found a shortcut to wealth. They call it momentum, timing, or riding the wave, but in truth, it's just fear of missing out dressed as strategy. The crowd buys because others are buying, not because they understand what they're buying. This herd behavior creates bubbles, temporary illusions of success built on borrowed confidence. When the trend reverses, as it always does, panic spreads faster than logic. The same people who were shouting about easy profits rush to sell at any price, desperate to escape losses they never saw coming. They blame luck, the economy, or manipulation, but the real culprit is their own impatience and lack of conviction. The investor who chases trends is like a leaf in the wind, constantly moving, but never in control. He mistakes activity for progress and speed for intelligence. The wise investor does the opposite. He ignores what is fashionable and focuses on what is real. He studies businesses, not headlines. He looks for value when others are distracted by excitement. He understands that true wealth is built quietly, not publicly. Trends promise quick results, but compounding requires time, patience, and consistency, things the trend chaser will never have. History is full of examples. The dot-com bubble, the housing mania, the crypto rush. Each started with optimism and ended with regret. Those who followed the crowd were destroyed by it. Those who stood apart and thought independently walked away stronger. In investing, chasing trends is not a strategy, it's surrendering your judgment to the noise of the crowd. Patience is a superpower. In a world that worships speed, most investors want instant results, fast profits, quick wins, and constant excitement. They cannot sit still because waiting feels like losing. Yet the truth is, the greatest returns come not from constant action, but from consistent patience. Wealth is built in silence through the slow and invisible process of compounding. The impatient sell too early or buy too soon. The patient let time do the heavy lifting. Every market cycle rewards those who can wait when others are restless. The problem is that patience feels uncomfortable. When nothing seems to happen, people begin to doubt their choices. They look at others making money and start questioning their own plan. They want movement, noise, proof that progress exists. But markets don't operate on human timelines. The world doesn't pay for excitement, it pays for endurance. The investor who can stay calm during stagnation, who can sit on good decisions while everyone else rushes for the next big thing, holds an advantage far greater than intelligence. Patience requires emotional strength. It's easy to be patient when everything is rising. It's harder when prices fall, headlines scream panic, and everyone around you loses faith. Yet those who master patience know that volatility is temporary and that value always reemerges. Time, not timing, creates wealth. The impatient constantly interrupt compounding by chasing new opportunities, while the patient understand that doing nothing can sometimes be the most powerful action. Every great fortune has a long, quiet story behind it. Years of waiting, years of holding, years of trusting a sound decision. Patience doesn't just multiply money, it shapes character. It turns investors into owners, traders into thinkers, and uncertainty into opportunity. The mind is the greatest asset an investor can possess, yet it can also be the most destructive enemy. Markets don't defeat people, their own thoughts do. Success in investing has less to do with IQ and more to do with emotional control. A brilliant mind filled with anxiety, greed, or impatience will make worse decisions than an average mind guided by calm reasoning. Every chart, every number, every trade passes through the filter of psychology. If that filter is clouded by bias or emotion, clarity disappears and mistakes multiply. The human brain wasn't built for rational investing, it was built for survival. It reacts to threats, follows crowds, and seeks instant gratification. Instincts that once protected us now sabotage us in markets. When prices rise, the mind creates euphoria and whispers, "You're missing out." When prices fall, it creates panic and screams, "Get out now." These emotional impulses lead investors to buy high and sell low, repeating the same painful cycle. The market simply reflects human behavior at scale, waves of fear and greed endlessly colliding. Mastering the mind means mastering these impulses. It means learning to separate logic from emotion, data from noise, opportunity from illusion. The investor who can stay rational in chaos holds an advantage no algorithm can replicate. He doesn't seek constant excitement. He seeks clarity. He doesn't react to every headline. He trusts his process. The battle isn't fought in the market. It's fought in the mind of the participant. A disciplined mind compounds not only money but wisdom. It learns from mistakes instead of denying them. It stays humble in success and steady in failure. In the end, your mind will decide your fate either as the architect of your fortune or the author of your downfall. Learning the rules of rationality and never breaking them is what separates lasting success from fleeting luck. The world of investing is filled with noise, hype, and constant temptation to abandon logic for emotion. Every cycle, people forget the basics. Buy value, avoid what you don't understand, think long-term, protect capital, and every cycle they pay the same price for that. Forgetfulness. Rationality is not complicated, but it is rare because it requires discipline. It demands saying no more often than yes. It means being content with slow progress while others chase shortcuts. It means trusting principles over impulses, even when the crowd mocks your restraint. The rules of rationality never change because human nature never changes. The rational investor doesn't predict markets. He prepares for them. He understands that uncertainty is constant and that protecting himself from stupidity is more powerful than trying to be brilliant. Avoiding big mistakes is often more valuable than seeking perfect decisions. The rational thinker accepts that emotions will arise, greed, fear, envy, but he refuses to let them dictate his actions. Breaking rational rules feels easy in the moment. It feels exciting to take a gamble, to follow the crowd, to believe that this time will be different. But every broken rule brings a lesson written in losses. Once you compromise logic for emotion, the market will remind you of the cost. Rationality protects you from your own weaknesses, from arrogance, from impatience, from the illusion of control. To stay rational is to stay grounded in truth, while the world loses balance. It's not flashy, but it's undefeated. The investors who endure, decade after decade, are not the ones chasing brilliance. They are the ones who learned the rules of rationality and never ever broke them.